Hello, I'm Elisa Zhang, and I'm a life and money coach. So, if you've heard of index and fund investing, do you really know what an index is? So, Investopedia defines a market index as a hypothetical portfolio of investment holdings that represents a segment of the financial market. So the index number is a calculation that comes from the price of the underlying holdings, and different indexes are weighted different. Weighting is just a method of adjusting the individual aspects of the items in the index. So weighting can be based on things like the market cap or the revenue. And so indexes are used to actually gauge the movement and the performance of different market segments. And it can be used as a benchmark for investors to actually compare the performance of their portfolio against whatever segment that they're invested in. So the three most popular and well-known indexes for the stock market in the United States are the Dow Jones Industrial Average, the S&P 500 Index, and the Nasdaq Composite Index. So the Dow Jones Industrial Index was actually introduced back in 1896, so over a century ago, and it was the first index of stock market activity. It actually was originally only 12 of the biggest companies and was chosen by Charles Dow. So Charles Dow was actually an American journalist, and he founded the financial news bureau called Dow Jones and Company with Edward Davis Jones. And so the Dow Jones Industrial Average was actually calculated, but just adding the closing stock price of the companies on the Dow Jones list and dividing it by the number of companies. Over time, more companies got added to the Dow Jones Industrial Average, and so now it's up to 30 companies. And of course, the 30 companies that are on the Dow Jones Industrial Average now are not the same as the original 12 companies. Over years, the companies have broken up and taken over, dissolved. New companies got bigger, and so as true with all these indexes, it is a it's constantly evolving. So the S&P 500 index is made by Standard & Poor's, and it's generally considered a better indicator of how the U.S. stock market is doing than the Dow Jones, partially because it's just like that many more companies. It's composed of all like larger companies in the United States, so it's not the full market. It doesn't have the mid cap or small cap companies, and it's not necessarily the largest 500 companies, but there are certain standards that were created for being in the S&P 500 index. And to be included, a company must be a U.S. company. It must meet a certain market capitalization requirement and be highly liquid. And so it also has to have a public float of at least 10% of its shares outstanding. With the most recent quarter's earnings and some of its trailing 4 consecutive quarters, earnings must all be positive. And so that market cap requirement increases over time. And as of 2022, to be included in S&P 500, you have to have a market cap of at least $14.6 billion. And the S&P index is actually calculated by adding the company's float adjusted market capitalization, which means that only the shares available to the public. So it's excluding all the shares that are held by management, government, or other companies. The Nasdaq Composite Index. So there's a Nasdaq like stock exchange, and then there's the Nasdaq Composite Index. And so the Nasdaq Composite Index is a market capitalization weighted index of the more than 3,700 stocks listed in the Nasdaq Stock Exchange. And that actually does include stocks that are headquartered outside of the United States. The Nasdaq stocks tend to be very technologically heavy, so it's not necessarily as great a indicator of the kind of whole of the U.S. stock market, because the different industries aren't weighted like the industries actually are in the U.S. So that's what an index is. So what's a mutual fund? Modern mutual funds were actually introduced back in 1924. There were in 1929, 19 open-ended mutual funds with about 700 closed-ended mutual funds. But mutual funds actually became a lot more popularized after the creation of the 401k. And and then in the 1980s, when there was a huge bull market in the United States, like the average investor really started to invest more in the stock market. So when you think about that, I was actually born in 1979, so I was actually alive at the time where the vast public actually really got into investing index funds instead of really just the wealthy. So index fund is a mutual fund that purchases all the stocks that are on a certain index. So an S&P 500 index funds purchases all 500 companies on the S&P 500 index and just holds them. And so index fund investing is a passive investment strategy, and it just seeks to match the risk and return of the market based on the index being purchased, as opposed to actively managed mutual funds, which are really trying to beat the market. So with an index fund, there's no possibility of beating the market, but you're also guaranteed to not lose any more than the market loses in a downturn. So on average, it actually does perform much better than active investing. And part of that is the fees are generally very low on index funds, and your fees eat away at your returns. And so having more profit can just come from having lower fees. So if you've got a mutual fund that is actively managed and does just as well as S&P 500 index fund, but it's got all these fees, now you're subtracting those fees from the profit, and that's severely affecting your return on your investment. So then there's index funds that are mutual funds, and then there's also what's called exchange-traded funds. And so exchange-traded fund is really just a pooled investment security that operates a lot like a mutual fund, but unlike a mutual fund, it trades throughout the day, so the price can fluctuate throughout the day, whereas a mutual fund just trades kind of at close, and so when you buy a mutual fund, you just buy it at the closing price for the day. But both mutual funds that are index funds or exchange traded funds are both really generally have low expenses and tend to be really tax efficient. All right, so again, examples of index funds include the S&P 500 index fund, the total U.S. stock market fund, the total international stock fund, a total bond market fund, and then there are also index funds that can be for specific sectors. So I hope this was educational about index fund investing, and hopefully that kind of gives you the foundation for understanding what you are doing when you buy an index fund. You're really buying a diversified portfolio of stocks. So if you buy the S&P 500 index fund, you're essentially buying 500 stocks, but all wrapped up together, and in a way that you're not paying all the transaction fees of buying like 500 actual stocks, and you're doing it in a way that's, in a market capitalized weighted way. And so it just makes for a good diversified portfolio following the whole of the stock market, which has grown on average after inflation about 7% growth. So of course that's on average. So there are years where it can go up 20-30%, and there's years where it can go down 20 or 30%, but 2/3 or 70% of the time it tends to go up versus down. So if you look at the stock market valuation over time, it has significantly increased, even though right now, as the time is recording, the stock market's been really volatile. But that in a way just means stocks are on sale, and expect that the value of these stocks will continue to go up as the value of these companies and what they produce. These companies grow, they produce more, and that makes the value of the companies more, which makes their stocks worth more, and that's why the stock market keeps going up with time. All right, well, thanks so much for watching this video. If you enjoyed it, I'd love to hear from you. If you would like to kind of learn more about investing, or just need a little bit more hand-holding when it comes to actually investing, even someone to kind of look over your shoulder while you're going into your brokerage account and making the purchase, or looking over all the different selections, or even talking about like, how to choose a brokerage firm to put your money. Some people even ask, is it really safe to have all your money in this in one brokerage firm? So those are all things that we can discuss. If that is of any interest for you, then I want you to head over to my website, growyourwealthymindset.com, and you can set up a Zoom call with me. I'd love to talk to you. And if you like these videos, please subscribe. You can also listen to the same information on my podcast, the Grow Your Wealthy Mindset podcast. There is an episode just on index fund investing, which goes into even more than what this video said. All right, thanks for watching.